So last week we completed the discussion on the discussion of the underlying concept of capital budgeting, and I promise you that today and then going forward for the next two periods or thereabouts. So all what we'll be doing are solving illustrations, solving questions. So today, what we need to do is to start solving questions. And I believe you have all gone through what we did in the discussion relating to capital budgeting so far. So let's apply all the concept and principle we discussed in the scenario questions that we'll be treating in the subsequent classes. Okay. All right, then let me share my screen with you. Let me see, how do we start? If I'm able to solve at least 4 illustrations, different scenarios, I will be happy. I'll be happy. So let's try this illustration. Let's start with illustration number 1 first. This is a 30 marks question that was tested in one of the previous diets. Okay. Can somebody help us to read this illustration? Yep. Who will help us to read?
Okay, I'm waiting.
Okay, Jide, thank you.
Yeah. TrueTalk Nigeria Limited is a fast-growing profitability company. The company is based in Lagos and has just won a contract to supply gas to the state's electricity board. In this regard, the company planned to commission a 35-kilometer pipeline at a cost of 260 million to enable it to execute the contract. The pipeline, when installed, will carry the gas to an agreed location under the control of the State Electricity Board. With all these arrangements in place, it is expected that the sales of the company will increase from the present 360 million to about 1,100 million. The anticipated revenue from sales to the State's Electricity Board is expected to be 120 million per annum. Apart from this contract, the pipeline could also be used to transport liquefied natural gas, LNG, to other willing customers in the suburb. The sales from this source are put at 80 million per annum. The management of TrueTalk Nigeria Limited considers the useful life of the pipeline to be 20 years. The financial manager estimates a profit to sales ratio of 20% per annum for the first 12 years and 17% per annum for the remaining life of the project. The project is not likely to have any salvage value. TrueTalk Nigeria Limited is located in a remote area, hence would enjoy exemption from tax. The company's cost of capital is 15%. You are required to distinguish between mutually exclusive investment and independent investment. B, why is investment decision important to organizations, and what techniques can be used to ensure that optimal investments are undertaken by firms? C, what is the project's payback period? D, advise TrueTalk Nigeria Limited given reasons as to the acceptability of the project based on the payback criterion. E, compute the project's NPV and IRR.
Thank you very much, Jide. That is the question. So without wasting more time, in the A requirements, you have to distinguish between mutually exclusive investment and independent investments. When I was explaining the concepts, especially when we go to net present value, I mentioned this, I've already done this, but let me just brief you. To answer the A requirements, The mutually exclusive investments is a competing investment in which the acceptance of one will preclude the acceptance of the other. For example, if project A and B, if investment A and B are mutually exclusive, the acceptance of project A will mean the rejection of project B and vice versa. I'm done with that. On the flip side, independent investment is a standalone investment in which independent investment is a standalone investment that can be accepted or rejected based on its own merits. For example, if a project produces a positive NPV, the project will be accepted. But if negative NPV, it will be rejected. That is independent investment or project. So when you do this, it is not sufficient for you to just give what's mutually exclusive or independent investment is all about. You are expected to give an example for you to be able to earn your 3 marks, full 3 marks. All right. If you define it without giving an example, examiner can just give you 2 over 3. All right. Next, number B. Why is investment decision important to an organization and what techniques can be used to ensure that optimal investments are undertaken by firm? Again, these I've explained to you when we're discussing the concept. Why is investment decision important? Why are you carrying out investing decision? I mentioned to you that, okay, let me just focus on this question. Investment decision is essential in order to ascertain the financial viability of the investments using relevant investment appraiser techniques. Okay, that's that. The second part of the B requirement is that what techniques can be used to ensure that optimal investment decision optimal investment are undertaken. So you then reply, you now answer that the techniques that can be used to ensure that optimal investment are undertaken by firm include net present value, internal rate of return, adjusted present value, payback period, modified internal rate of return, accounting rate of return, etc. Once you do that, again, you earn your full mark. Okay? Then number C, what is the project payback period? So now we want to do calculation. Examiner is asking you, what is the project payback period? You want to calculate payback period. So the first thing you need to do is to ascertain all relevant cash flows from the question. So the cash inflow, the cash outflow, those are the 2 variables that you need. Of course, you also need useful life of the project. You don't need cost of capital for you to be able to calculate your payback period. Therefore, let's go to the question and identify all relevant cash flows. All right. So let me switch to the working notes so that within the next few minutes, we are done with the illustration. We can pocket the 30 marks. So the name of this company is TrueTalk. Okay. TrueTalk Nigeria Limited. Okay. Number C, examiner is asking you to calculate payback period. So calculating payback period. Please, on the day of your exam, don't go and be writing PBP. You have to write it out in full, at least for the first instance. Payback period must be written in full, in bracket, PBP. Okay, so I will use this page for the payback period. Then after payback period, you also have to calculate, you have to advise, okay? That will be half a page. Then you have to calculate NPV and then internal rate of return. Worst case, let's say we are going to use 1.5 pages, or let's say 2 pages. So let's do our workings. I will then come here. Workings. So let's go back to the question. Open to the question on your side. Let's pick all the variables that we need. From the first paragraph, examiner has told that when Jide was reading, you are told that in this regard, the company plans to commission a 35-kilometer pipeline at a cost of 260 million naira to enable it to execute the contract. So that 260 million naira is the initial outlay. So I have initial outlay of 260 million naira. Okay. Next item. You're now told that the pipeline when installed, will carry the gas to an agreed location under the control of the State Electricity Board. With all these arrangements in place, it is expected that the sales of the company will increase from the present 360 million to about 1.1 billion naira. Whether the sales revenue increase or not, I'm less concerned with that. We don't need incremental sales for anything. What I'm looking for is the cash inflow and cash outflow. Examiner has not told me that, examiner in that paragraph, examiner did not tell me that the amount of revenue that will be earned. Therefore, I will ignore that. Move to the next one. In the second paragraph, the anticipated revenue from sales to the State's Electricity Board is expected to be 120 million naira per annum. Yes, that's the information I'm looking for. So I would then say revenue or sales. There are 2 categories of sales according to the question, 2 sources of sale. One is from State's Electricity Board. The sales at this level we are told is 120 million naira. 120 million naira per annum. Next, apart from these contracts, the pipeline could also be used to transport liquefied natural gas to other willing customers in the suburb. The sales from this source are put at 80 million naira per annum. So another sales, which is from LNG, 80 million. Okay. Next paragraph. The management of True Talk Nigeria Limited considered the useful life of the pipeline to be 20 years. So I also see another information I'm looking for. Useful life. This is one variable. Another one. Then we are told that useful life of this project is 20 years. Next, the financial manager estimates a profit to sales ratio of 20% per annum for the first 12 years and 70% per annum for the remaining life of the project. The project is not likely to have a salvage value. Scrap value is equal to 0. So examiner has told me that profit to sales ratio is the same thing as contribution margin ratio. So the percentage of contribution on sales is what the examiner has given to me. Therefore, how much was the total sales? Sales is 200 million. Total sales is 200 million per annum. Okay, so contribution. Examiner told me that for the first 4 years, 1 to 12, the first 12 years, the percentage of contribution is 20%. 20% on sales. So 20% of 200 million equal to 40 million per annum. . Okay. Then from years 13 to 20, we are told contribution margin ratio is 17% of the 200 million naira. So annual contribution will be 34 for the next 8 years. 34 million naira per annum and for the next 8 years. What else? The company's cost of capital. TrueTalk Nigeria Limited is located in a remote area, hence will enjoy exemption from tax. That means our cash flow will not be impacted with tax. The company cost of capital is 15%. So to calculate payback period, I don't need cost of capital, but for the purpose of NPV and then internal rate of return, so we need to indicate this. Cost of capital equal to 15%. So these are the relevant cash flows. These are the relevant variables that we need to do justice to this calculation. Therefore, now we know that we want to calculate payback period. How am I going to calculate my payback period? When I was explaining the concepts, I said that payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investment. That is, how quick can a company recover the amount invested in a project? Therefore, you want to know, as far as this question is concerned, and I also explained to you, there are two ways you can calculate your payback period, depending on the nature of the cash inflow. If you are given a constant cash inflow, then payback period will be the ratio of cash outflow to constant cash inflow. But when you are given irregular cash inflow, if your cash inflow given to you are different year on year, then in that case, you cannot use formula. Rather, you are supposed to use the tabular method to get your payback period. However, for me to conclude in this question, for me to conclude whether I should use formula or tabular method will depend on the nature of my cash inflow. However, according to this question, examiner has told you that the annual cash flows from year 1 to 12 is 40 million naira. Okay, annual cash inflows is 40 million naira. So when you multiply 40 million by 12 years, so I will say 40 million, 12 years, multiplied by 40. This will give me about 480 million. Okay, when I multiply this 40 by 12 months, sorry, by 12 years, so that will give me 480 million. So if that is the case, that means for the next 12 years, this company will earn 480 million naira from the project. However, what's the initial outlay of the project? The initial outlay we have determined, according to the question, is 260 million, which means that the company will recover its investment of 260 million naira within the next 12 years, because the 12 to 260 million naira is within the 480 million. Therefore, I can use formula to do my calculation on this instead of me to list year 1 to 20. Okay, 40 year 1, 40 million, year 2, 40 million, year 3, 40 million, up to I get to year 12, 40 million. When I get to year 13 to 20, I will also say 34 million, 34 million. That's primary school method. That is an average student kind of calculation, because I need to think outside the box. Because if my cash flow is constant from year 1 to 12 at 40 million naira, therefore I will multiply it by 40 million or by 12 years. That will give me 480 million. So, and then the initial outlay is within the 480 million naira. Therefore, I need to use formula to get my payback period. So let's go up there. I will then say payback period equal to cash outflow divided by constant cash inflow. Of course, you have to express your payback in years. Therefore, cash outflow is 260 million naira. Cash inflow is 40 million naira per annum for the next 12 years. 12 years. Therefore, this will give me 6.5 years. So this means that this project will pay back within the next 8 years, 7 years. So examiner is now asking me, what's the project payback period? I will just say the project payback period. I will say the projects will pay back. We pay back the invested capital of 260 million naira within the next 7 years. So 6.5 is within 7 years. Okay, that's what I need to do. If you want to use primary school method, you want to do as an average student that is confused on what to do. So if you want to use primary school method, you create a column for year, you have cash flow, you have balance or cumulative, then year 0. Your initial outlay is 260 million. That's what you want to recover. Then year 1, year 2, year 3, year 4, year 5, year 6, year 7, on and on like that. So you get to year 12. Okay. After year 12, you have year 13. You continue to do like that till you get to year 20. Okay, till you get to year 20. So here this one is constant up to year 12. Okay. Constant. This is a way. How could you be doing this at this level, at professional level? How could you be doing all of this? This is primary school. You shouldn't be doing this. So that's what I said. You must be able to think outside the box. This guy here is 34 to get to the final one, 34. Therefore, 260 minus 40 will give me 220. So 220 minus 40 will give me 180. 180 minus 40 will give me 120. Sorry, 140. 140 minus 40 will give me 100. 100 minus 40 will give me 60. 60 minus 40 will give me 20. When you get to a point where the outstanding balance is lower than the next cash inflow, you put a dash, then you calculate your payback period. I would then say payback period equal to how many years have I recovered? 1, 2, 3, 4, 5, 6. I've recovered 6 years plus the outstanding balance of 20 million divided by the next cash inflow of 40. So this will give you 6.5 years. Why should I be doing all of this stress when I can do it within a few seconds? I will get my answer. You don't need to be doing all this kind of a primary school calculation. Please, you are beyond this. So you must be able to think outside the box and what you need to do at the right time. Okay? So that's for that. Now, what's the next thing? Let's go back to the question. Number D, advise TrueTalk Nigeria Limited, given reasons as to the acceptability of the project based on the payback criterion. So I also explained to you when I was giving you the, when I was discussing the concept with you, I mentioned to you, I gave you the decision rule on payback period. We said that for independent project, accept if payback period is shorter or equal to management predetermined payback period. And for mutually exclusive project, accept any project with a shorter payback period, provided it is equal to or shorter than management targeted payback period. So what this simply means is that for the acceptability of a project using payback period, you must compare your calculated payback period with the management intended or predetermined payback period. And I specifically told you, I told you that note the following. When management predetermined payback period is not given, there will be no basis for the acceptability of the project because you need to benchmark with the management targeted payback period. When you look at this question on True Talk Nigeria Limited, we are not given management predetermined payback period. Therefore, on what basis do you want to compare your calculated payback period of 6.5 years with, on what basis do you want to determine the acceptability? Therefore, your response should be that number D. Okay, is it number D? Okay, number D. I will then say, let me rewrite this. So, the projects I've already said that in my comments, the project will pay back the invested capital of 260 million naira. So to continue from that information, I will say, since the management targeted or predetermined targeted payback period is not given, there will be no basis. There is no basis. There will be no basis for the acceptability of the project, even though the projects, even though the calculated payback period is within 7 years, as shown in C above. That's it. There is no basis for the acceptability of the projects because you need to benchmark your calculated payback period with the management predetermined or targeted payback period. So that's that. That's my response to that. You don't benchmark your calculated payback period with the useful life of a project. That's a wrong notion. It has to be based on the anything you want to do under the non-discounted cash flow method must be benchmarked against the management predetermined figures. Okay, so that let's go to E. For the E part, you have to compute the NPV and the IRR of the project. Number E, calculating NPV and internal rate of return. Please don't use the method I want to use now. On the day of your exam, you have to separate it. But for the purpose of this class, I will use only one table to do the two. Ordinarily, you are supposed to use a table to compute your NPV, then another table to compute your internal rate of return. However, for the purpose of this class, I will use only one table to achieve the two. Therefore, I want to calculate NPV. So I will create a column for year, cash flow, discount factor. Because of IRR, I will use double discount factor. Then I will have a column for present value. Okay, so year 0, our cash flow, we have cash flow from year 1 to 12. We also have another cash flow from year 13 to 20. Okay. All right. NPV. So The cost of capital, when you want to calculate NPV, of course, I told you there are three variables that must be present. One is appropriate cost of capital, which is 15%. Then, of course, the second is the relevant cash flow. Then third will then be the useful life of the projects. Okay. So here is at 15%. Okay. All right then. So let's compute our NPV. Our initial outlay is 260 million for year 0. Discount factor at year 0 is 1. 1 multiplied by 260 will give us 260 million. Okay. Then our cash flow from year 1 to 12. Contribution is 40 million. From year 13 to 20 is 34 million. Therefore, because our cash flow is constant from year 1 to 40, we need to calculate annuity factor. Then again, how do you then calculate your annuity factor of year 13 to 20? There is no formula to do that. Therefore, you are going to calculate annuity factor of year 1 to 20, then you less annuity factor of year 1 to 12. The difference will give you annuity factor of year 13 to 20. So let me show you. Annuity factor. AF. So annuity factor is calculated as 1 minus 1 plus R raised to power minus N, all of this divided by R. So at 15%, okay, annuity factor at 15%. So I need to calculate from year 1, years 1 to 20. I will calculate another one from years 1 to 12. So the difference will now be the annuity factor of years 13 to 20. Okay, I will less this one. So that will give me annuity factor of year 13 to 20. That's what I will use. Then let us calculate. Bring out your calculator and give me annuity factor of year 1 to 20. What do you get?
6.259.
6.259. So what about year 1 to 12?
5.421.
5.421 minus 6.259.
0.838.
0.838. That's it. So we have computed annuity factor for years 1 to 12 and years 13 to 20. So let's go and apply that. 5.421. Annuity factor of year 1 to 12. Here is 5.421, 0.838. So let's multiply to get the present value. 40 multiplied by 5.421. What do you get? Yes?
217.
217. Okay. What about 34 multiplied by 0.838?
28.
28. Okay, 28 plus 217, that's 245. 245 minus 260 will give you minus 15. So the NPV is negative. The NPV of this project is negative because we calculated negative 15 million naira. So examiner has you to calculate NPV. So when you use your table, you calculate NPV, then you got 15 million. That's it. Examiner did not ask you to advise. Then in the second requirement of the number E, you have to you have to calculate internal rate of return. So since I've used 15%, the cost of capital of 15% to calculate negative NPV of 15. So I can assume 10% cost of capital to calculate my internal rate of return. So I can just come here to say 10%. Let's see what 10% will give us. Here is 1. 1 multiplied by 260 million will give us 260 million. So let's go and calculate annuity factor at 10%. So I can say at 10%. Okay, so somebody should give me an annuity factor of years 1 to 20 at 10%.
8.514.
8.514. Then years 1 to 12.
6.814.
6.814. So what's the difference? One point what?
1.7, sir.
Okay, 1.7. Okay, so 6.814. So I will then come here. 6.814. 1.700. So let's multiply, please. Forty multiplied by 6.814. What do you get?
273.
273. 34 multiplied by 1.7.
58.
58. So 58 plus 273 minus 260.
71.
71. Okay. So that's this. So now that we have, it means that when we are calculating our internal rate of return, we assume 15% and 10% cost of capital. So at this point, we need to calculate IRR. We'll then say IRR equal to A plus NPV of A divided by NPV of A plus NPV of B into higher cost of capital minus lower cost of capital. So IRR equal to 10% is lower. So 10 plus NPV of 10, which is 71, divided by 71 plus 15. All of this multiplied by 15 minus 10. Final answer, what do you get? 17 divided by 86 multiplied by 5 equal plus 10 equal. What do you get?
14%.
14 points. 14 point what? What's your final answer? 14 point what?
14.1.
14.21, or what did you say?
12.
40.12, okay. So approximately our IRR is equal to 14%. So if you ask to, you see that Adibin were asked to make a decision on NPV and internal rate of return. You will notice that the decision of NPV will be consistent with the decision of internal rate of return because this is an independent project. The NPV is negative. That means the project is not viable. Also, the internal rate of return is lower than the company cost of capital of 15%, which means the project is also not viable. Okay, so that's that. So this is end of the question. Remember what I told you. The requirement says you should compute the project NPV and then internal rate of return. Don't go and do this on the day of your exam by merging NPV and IRR together. What you are supposed to do first thing first is to calculate your NPV normally. Once you are done with that, if your NPV is negative, then you can then draw another table for 10% cost of capital. So to get the positive NPV of 71, then you proceed to calculate your internal rate of return. Don't go and be looking for a shortcut always, okay? So the essence of this is because I know I want to calculate IRR. That's why I have to match the two together. But on the day of your exam, don't go and do that, okay? Don't go and do that, except you are lucky to meet a liberal or easygoing examiner or someone that will mark your scripts. So otherwise, you may be penalized. So you have to do it separately. All right, then. So let's move to another illustration, please. Let me know. Do you have any question on this before we switch? Any question on this? If there's no question, we'll move to another illustration. So I will stop sharing this. Let me see illustration number 2. Let me go down there first. Now, in the, I think we solved the A part of this question, number 3, or is it number 3 or number 4? Yes, we solved the A part of this question when we had project-specific cost of capital. Please correct me if I'm wrong. When we had project-specific cost of capital, did you solve this Ferrari? The A part of it. Confirm. Well, your silence means it's true that we have solved it. So let's go to the B. The B part of the question is talking about NPV. So yes, I need somebody that have eaten tonight to read this question for us. Yes. Who will help us to read? Why are you all quiet? Oh, you are not online? Ayodele, Opeyemi, Deborah, Elvis, all of you, are you saying you are not online?
We didn't solve this Ferrari.
The A
What
part?
happened was that, no, we did not. What happened was that you were supposed to do it, but because of that the other questions, is now deferred it. We did others,
Kilimanjaro.
but not this one. We did Abakaliki, I think. Oh, no, Abakaliki was assignments.
No, I'm even talking about under project specific.
No, we didn't. We didn't do it. We didn't
It's
do for
okay.
Ferrari. We
So
did
in that
Singapore.
case, no worry. So in that case, we have to solve the complete. No worry then. Then, yes, I need somebody to read for us, please. Who will take the lead? Okay, no worry, I will mention name. All of you have been quiet since. Jide will not read again. So tonight, let me call another person. 1, 2, 3, blah, 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 blah. Then, Muriel, please read.
Yes, sir. Can you hear me?
Read on.
Okay. Ferrari PLC, a listed company based in Warri, Delta State, has been involved in producing boats, but excluding the engines. The company is now considering diversifying into production of a major component of boat engine. For this purpose, the company has recently purchased the patent rights for 15 million to produce the components. Ferrari PLC has spent 20 million naira developing prototypes of the components and undertaking market studies. The research studies came to the conclusion that the component will have a significant commercial potential for a period of 5 years, after which newer components will come into the market and the sales revenue from the component will virtually fall to zero. The research studies have also found that in the first 2 years, that is the development phase, there will be considerable training and development costs, and fewer components will be produced and sold. However, sales revenue is expected to grow rapidly in the following 3 years, that's the commercial phase. It is estimated that in the first year, the selling price will be 2,000 per component. The variable cost will be 800 naira per component, and the total direct fixed cost will be 6 million naira. Thereafter, while the selling price is expected to increase by 8% per year, the variable and fixed costs are expected to increase by 5% per year for the next 4 years. Training and development costs are expected to be 120% of variable costs in the first year, 40% in the second year, and 10% in each of the following 3 years. The estimated average number of outboard engine components produced and sold per year is given below. Machinery costing 480 million naira will need to be installed prior to commencement of the component production. Ferrari PLC has enough space in its factory to manufacture the components and therefore will incur no additional rental costs. Tax allowable depreciation is available on the machinery at 10% on straight line basis. The machinery is expected to be sold for 160 million naira at the end of year 5. The company makes sufficient profit from its other activities to take advantage of any other tax relief available from the project. Initially, Ferrari PLC will require additional working capital for the project of 20% of the first year sales revenue. Thereafter, every 1 naira increase in sales revenue will require a 10% increase in working capital. Although this will be a major undertaking for the company, it is confident that it can raise the finance required for the machinery and the first year's working capital. The financing will be through a mixture of a rights issue and a bank loan in the same proportion as the market values of current equity and debt capital. Any annual increase in working capital after the first year will be financed by internally generated funds. Coscharis PLC is a listed company involved in the manufacture of outboard engine components for many years. Then additional data, we have the extracts from the statements of financial position, showing the non-current assets, the working capital, reserves, current market value per share, and the quoted beta. The loan notes of Coscharis PLC are quoted at 102 naira per 100 naira. Other data. Tax rate applicable to Ferrari PLC and Coscharis PLC is 20%. It can be assumed that tax is payable in the same year as the profits on which it is charged. Estimated risk-free rate of return is 3%, and the historic equity market risk premium is 6%.
Miriam, I couldn't hear you again. I think it's the network. Let me continue from here. From the requirements, okay. Miriam, I couldn't hear you. All right, let me continue from here. Thank you, Muriel. So from the requirements, given the information on Coscharis PLC and the project financing mix, including any other relevant information, calculate the project specific cost of capital. So examiner was kind of liberal here by telling you specifically that you should calculate project-specific cost of capital. Then B, assess whether Ferrari PLC should undertake the project of developing and commercializing the component of outboard engine, assuming a discount rate of 12% has been applicable for the assessment, irrespective of your calculations in here above. C, state any three relevant assumptions made for your calculation in A and B above. Okay, so that's the question. 30 marks. 30 marks. So in the A part, you are required to calculate project specific. So which is very direct requirement. This is a direct requirement. However, like I told you already, when I was explaining project specific, I mentioned to you that project specific is computed when a company is diversifying into a new industry. As a result, a new cost of capital that will be consistent with the risk, with the systematic business and financial risk associated with the project will need to be estimated. When you look at the first paragraph of this question, examiner has told you that Ferrari is now considering diversifying into the production of a major component of outboard engine. So, and you are now asked to calculate cost of capital. In case you are not told to calculate project specific, so you can see diversifying, when you see diversifying in the question, or when you see that the company is moving from one industry to another industry, it is implied that the company is diversifying, and you are asked to calculate cost of capital. There is no other cost of capital you are going to compute other than the project specific. So without wasting more time on this question, I will stop sharing this and move to the working notes. Okay. So like I explained to you, whenever you want to calculate project specific cost of capital, whenever you want to calculate project-specific cost of capital, there are 5 procedures you are expected to carry out. The first procedure is to identify the proxy beta. Step 2, you ungear the beta if the beta in step 1 is geared. The beta in step 1 will be geared if the proxy company has debt in its capital structure. Then step 3, you re-gear the beta. Okay, you re-gear in order to incorporate the financial risk of Ferrari. Then step 4, you calculate capital as a pricing model. Then step 5, you calculate WACC. That WACC is the project-specific WACC. So that's what we want to do. Therefore, I would then say Ferrari PLC. Number A, requirements. Calculating project-specific cost of capital. Step 1, proxy beta. There is no need for you to come and say, identify proxy beta. Leave all those stories. Just bring out your beta that you have identified from the question. So proxy beta. I will go to the table. From the table given to you, you can see where you have additional data. The last line item, quoted beta. For Ferrari, 1.3. For Costarris, 1.8. Ferrari is the main company. Ferrari is the one that is undertaking the project of commercializing this outboard engine. So Costarris is another company, which is the proxy company in this case. So the proxy beta is 1.8. So I would then say 1.8. So with this, I've identified the beta. Step 2 said you should ungear. Now, you only put down the ungear if and only if the beta in step 1 is geared. How do you know the beta is geared? You go to the balance sheet of the proxy company of Costarris PLC. Go and identify if Costarris PLC has debt in its capital structure. When you look at the balance sheet of Costarris, you will see 5% loan note from year 2020 to 2022 of 368 million. That 368 million is a debt. Loan note is a type of debt. Therefore, it means that the beta of 1.8 is geared. So if the beta is geared, you need to ungear it. So you are going to ungear in order to remove financial risk. Therefore, before you put down your formula, you must also identify from the question if debt beta is given. If debt beta is given. So in this question, examiner did not give us debt beta, because if you are given debt beta, you are expected to use the extended formula. But if you are not given debt beta, it is assumed that debt beta is risk-free. Therefore, according to this question, we are not given debt beta. So it is assumed that beta is risk-free. Therefore, if that is the case, my beta assets is calculated as beta equity of a gear multiplied by equity value of coshares of the proxy divided by equity value. Let me rewrite this. Equity value plus debt value multiplied by 1 minus tax. So this is the formula that we are going to use to ungear. I can either use this formula or I use another formula. Whichever one I use, I'm going to get the same answer. I can also say beta assets equal to beta equity of a gear, beta equity of a gear multiplied by 1 divided by 1 plus 1 minus tax, debt equity proportion of the proxy. Okay, so whichever one I use, I will get the same answer, irrespective. It's the same answer that I will get. Okay, so just use one. Don't go and be demonstrating too much skills on the day of your exam. Just use one that is more convenient for you. Now move on. Examiner does not ask you to go and be showing too much skills. All right, you are in class, so I have to give you options. Anyone that is more convenient for you, you do. But at all time, always use this one. Okay, because when you want to do for where the when you are given debt beta, of course, you have to use the extended formula. So this one, including the other part, so it's what you are going to use. So that's what I said. Always use the first one. Okay, then. So beta asset will then be equal to beta equity of a gear is 1.8. The gear beta is 1.8. Okay. So we need to go and calculate equity value. In this question, examiner did not give us equity value. At times, examiner can give to you the gearing ratio. The debt equity proportion may be given to you, say, for example, 30%. Examiner can tell you that debt equity ratio is 30%. If debt is 30%, it implies that equity is 70%. Again, you can also give gearing ratio of 40%. Meaning that debt is 40, equity will be 60. That is, if examiner did not define your gearing ratio for you, at times examiner can define the gearing ratio by telling you that you should use total value. So if you are asked to use total value, then if you are given a gearing ratio of 30% and you are asked to use total value, then in that case, debt will be 30%, equity will be 30 plus 70, which is 100. So that will now be 30 over 100. But if examiner is silent, so you are at liberty to just say, debt is 30, equity is 70, or debt is 40, equity is 60. So it all depends. All of these I've explained in our first class. I'm just repeating it. Therefore, I want to calculate equity value. In this question, we are not given equity value, so you need to go and calculate it. How do you calculate your equity value? I've already demonstrated it for you also. When we had, let me see, this will be working number, this is number 2, number 3, number 4, number 5. So the whole page should be sufficient. So, okay, let me just give an extension. So working, we also have to calculate NPV. Okay, let me do it this way. This will be for my NPV and the decision. Then let me put my working to this place. So workings, because you shouldn't be missing workings with the main solution. Working should be the last thing you are going to write, or you are going to last page you are going to create. So the first working we want to do is to calculate market value. Working number 1, market value. So market value of equity, like I said, we've already discussed it when we are doing the cost of capital. So how do you calculate market value of equity? Depending on the information given to you in the question. If you are given number of shares, market value of equity is number of shares multiplied by XDIV share price. When you are calculating project specific cost of capital, forget about XDIV share price. Just put in share price, okay? So you go to the question. Are you given number of shares? No, there's no number of shares. Examiner only gave us the share capital. Therefore, if you are given share capital, then I need to convert the share capital to number of shares. So share capital divided by nominal price multiplied by XDIV share price. Like I said, simply put share price. It is only when you are using traditional method of calculating WACC that we'll be talking about XDIV share price. Under project specifics, you are not using that. You are less concerned with whether dividend has been paid or not. Just move on. All right. So then for Coscharis, the market value of equity, I will then go to the question, what's the share capital of Coscharis? The share capital of Coscharis is, yes, 500 million naira at 1 naira. At 1 naira per share. So 500 million. So I will come here, 500 million divided by 1 naira. So that will give me 500 million shares. Then multiply by, what's the share price of Coscharis? The share price is 3 naira. So multiply by 3 naira. So this will give me 1.5 billion. Okay, this will give 1.5 billion. So that's the market value of equity of Coscharis. Let's calculate market value of the debts. Market value of the debts. So D, debts. Okay. For Coscharis, before that, debt will be calculated depending on the information given. Let's go back to the question. The debts, when you look at the balance sheet of Coscharis, balance sheet has 5% loan notes of 368 million naira. Loan note is a type of a debt. Therefore, in that case, for me to get the market value of the loan note, I would then say nominal value multiplied by X int price. Okay, multiply by X int price. Again, you are less concerned on whether interest has been paid or not. Just say interest divided by 100. If you put X int price, no worries. Okay, interest divided by 100 naira. Therefore, for Coscharis, the nominal value is 368 million naira multiplied by the value, the market value of the debenture of the loan notes. We are told is 102 naira per 100 naira. That means the loan note is quoted at 100 naira per unit. So here is 102 divided by 100 naira. So what do you have here? 1.02 multiplied by 368. What do you have?
375.36.
So that's 375 million approximately. That's the value of the Coscharis loan notes. Value of equity of Coscharis is 1.5 billion. The value of the loan note of Coscharis is 375. Therefore, let's continue with our calculation. So value of equity is equal to 1.5 divided by 1.5 plus value of the loan note D, which is 375, into what's the tax rate given to us? Examiner told us tax rates of Ferrari and Coscharis is 20%. So if tax rate is 20%, Then we are supposed to account for 80%. That is 1 minus 0.2 will give us 0.8. That's it. Give it to me. What's your final answer? 0.8 multiplied by 375 equal plus 1.5 equal 1.5 divided by answer equal answer multiplied by 1.8 equal. Give it to me. What do you get?
5.
Yes.
1.5.
1.5. Thank you. So 1.5 is the on-gear beta. On-gear beta is the same thing as asset beta. Asset beta measures only business risk. So we have determined the beta that measures business risk. So step 3 now. Step 3 is to regear in order to incorporate financial risk of Ferrari. Okay, we need to incorporate financial risk of Ferrari. So you regear. So when you want to regear, the formula you use in step 2 will depend on the formula you are going to use in step 2. So in step 3, since debt beta is risk-free, therefore, for me to regear, then beta equity of a gear will then be equal to beta asset we computed in step 2 multiplied by 1 plus 1 minus tax debt equity proportion of Ferrari. Okay, like I explained, when you get to step 3, step 4, and step 5, you need the information of the main company. The main company in this question is Ferrari. From step 1 and step 2, you need the information of the proxy company, which is Costaris. So we are done with the proxy company. Now we want to face the main company because it is Ferrari that wants to execute the project. Therefore, you need to incorporate both business and financial risk into the project because the cost of capital you are going to use to appraise this project must be consistent with the risk associated with the project, both business and financial risk. Okay? Therefore, I would then say beta equity of a gear equal to 1.5 multiplied by 1 plus 0.8 debt equity proportion of Costaris, sorry, of a Ferrari. Let's go and calculate that. Debt equity proportion of Ferrari. So what's equity value of Ferrari? Ferrari equity value equal to, let's go back to the question in the balance sheet. The share capital of Ferrari is 208 million naira at 50 kobo. So the same formula you have up there, share capital is 208 million at 50 kobo, 0.50 multiplied by share price. The share price of Ferrari is 3 naira 50 kobo, 3.5. So what do you have? 2.8 divided by 0.5.
156.
1456. Okay, thank you. That's the total market value of equity of Ferrari. Then the debt of Ferrari, D. We want to calculate market value of the debt of Ferrari. When you look at the balance sheet of Ferrari, Ferrari has 6% bank loan. Bank loan is a type of non-traded debt. A non-traded debt is the security that cannot be bought or sold in an organized financial market. You can't have market value for bank loan. You cannot buy or sell bank loan. Therefore, you can't have market value for it. So it's the book value that you are going to use, which is 624 million naira. So I can say bank loan equal to 624. That's 624. Add the two together. That will give me 2080. So total value. So the total value of Ferrari is 2,080 million naira. That's that. So if that is the case, we can then go up there. Okay. So debt, which is D, is 624 divided by equity of 1456. Final answer, give it to me. 624 divided by 1456 equal, multiply by 0.8 equal, plus 1 equal, multiply by 1.5 equal. Give me the final answer. Yes.
2.014.
2.014. So that's 2.01. Okay. So that's the beta equity of Ferrari. Step 4 says you should calculate CAPM. CAPM. Cost of equity denoted as KE. Therefore, I can say KE equal to risk-free rate of return plus the beta in step 3 multiplied by market return minus risk-free rate of return. Okay? So KE equal to, according to the question, what's the risk-free rate of return? Estimated risk-free rate of return is 3%. So here is 3 plus beta of 2.01 multiplied by what's market return? Examiner did not give us market return. You are given historical equity market risk premium. Risk premium is the difference between market return and the risk-free rate. The difference between these two guys represents risk premium. Therefore, we are given risk premium to be 6%. Okay? Here is 6. So I don't need to go and be looking for market return again. Examiner has made life easy. Therefore, I will then say KE equal 6 multiplied by 2.01 equal plus 3 equal. What do you get?
15%.
3.6.
15 points. 15 point what?
16%.
16.06. Am I correct?
No, 15.84, 16%.
It can't be 15.84.
15.06.
Okay, 2.01 multiplied by 6. So that should give you 12.01 or whatever. Then plus 3. That will give you 15.06. Finally, step 5. We calculate project specific work. KW. Therefore, KW equal to equity value over equity plus debt multiplied by cost of equity plus debt value over equity plus debt, cost of debt, 1 minus tax. All of that multiplied by 100%. So on the left side, equity value of Ferrari is 1456. Total value is 2080 we computed. Multiplied by cost of equity of 15.06% plus debt value of 624 divided by total value of 2080 multiplied by cost of debt. I will then go to the question, what's the KD? KD is the coupon rate, the interest rate on the debt of Ferrari. The debt of Ferrari is 6% bank loan. That 6% is your KD. That's the interest rate or coupon rate. So here is 6% multiplied by tax. Tax of 20%, 1 minus tax. So we're accounting for 80%. So give me from the left. 1456 divided by 2080 multiplied by 15.06. What do you get? From the left. Yes.
0.11.
0.11. It can't be now. You know you are using. Forget about the percentage you have behind
That's
it.
1.44.
I can't see your voice.
1.44.
1.44 for the other side.
Yes.
Yes, sir.
1.44%. From the left, what do you get?
That's 10.54.
10.54. Thank you. 10.54%. Add it up. What do you get?
That's percent.
That's 11.98.
11.98%. That's 12%.
So, yes, approximately the project-specific work is 12%. So that's what examiner asks you to do. It's just 5 marks. Out of 100 marks, you have pocketed 5 marks. You are looking for 95. So when you do it like this, that means what you have done is perfectly okay. So that's that. Digest it. Let's go to the B part. In the B part of the question, you are to assess whether Ferrari PLC should undertake the project of developing and commercializing the major component of outboard engine, assuming a discount rate of 12% has been applicable for the assessment, irrespective of your calculation in A above. So examiner is asking you to assess whether the company should undertake the project. Now, I've already explained to you, whenever you are asked to determine financial viability or to advise whether the project is financially viable or project is worthwhile, or you are asked to evaluate or you are asked to assess, there is no other technique the examiner is asking you to use other than net present value, except if examiner says otherwise. Once you are just told to assess, what examiner wants you to calculate is NPV, okay? If examiner wants you to use other technique, you are going to be told specifically that you should use a particular technique. But where examiner is silent and you are asked to evaluate, you are asked to advise, you are asked to advise whether the project is financially viable or worthwhile, or you are asked to assess, then it means you have to use NPV. Now, you want to calculate NPV. How are you going to calculate your NPV? I told you specifically there are 3 major variables that must be present whenever you want to compute NPV or you want to ascertain financial viability of a project using discounted cash flow method. There are 3 key variables that must be present. 1 is appropriate cost of capital. 2 is relevant cash flow. 3 is the useful life of the project. In this question, examiner has given us appropriate cost of capital to be 12%. Okay. 2, we have been given the useful life of the project. According to the information given in the question, the useful life is 5 years because the units produced and sold given in the question is for 5 years. Examiner also mentioned it in the question as well. The project is for 5 years. So then the only one the examiner will not give to you specifically or explicitly is relevant cash flow. This is where you have responsibility. And that is also why I took my time to explain to you what relevant cash flows are all about. We talked under the relevant cash flow. We talk about variable cost. We talk about fixed cost. We talk about direct, attributable, specific, incremental fixed cost. We talk about historical cost, sunk cost. We talk about depreciation, amortization, and provision. We talk about interest. We talk about opportunity cost. We talk about working capital. All of this, I explain how you are going to treat them when you see them in a question. Now is the time for you to apply all those principles that you have learned, all the concepts that you have learned. You need to apply it in this calculation. So let's take it one by one. So we go back to the scenario, one after the other, we'll begin to pick the cash flows. But however, before you do that, you need to go and design your table. You want to calculate NPV. That table is already gone. Well, sorry, that page is already gone. Let me use another page. So working, this is requirement number B, calculating net present value. I will put my figures in millions. As given in the question, my figures will be in millions. Should I use millions? Yes. I can use millions and I can also use thousands. Irrespective. Okay? Irrespective. Let me use thousands for my figures. Whatever you are using, you have to be very consistent. Don't go and do mistake. If you are using thousands, make sure you use thousand all true. If you want to use million all true. So that, or if you want to use absolute number, ensure you use your absolute number all true. Don't go and make mistake by mixing absolute value with thousand or with million. So the useful life of this project is 5 years. Therefore, I will create it. I will then, before I put down number of years, I need to go back to the question. How am I going to pay tax? What is the timing of the cash flow? When is the company going to pay tax? According to the question, we are told that tax, it is assumed that tax is payable in the same year as the profit on which it is charged. So tax is paid in the current year. So no need for extension. I can then say year 0, year 1, year 2, year 3, year 4, then year 5. That is too close. Let me give a space. Little bit. Year 0, year 1, year 2, 3, 4, 5. Then I will create additional column for workings. Okay. I don't know the extent of my table. I will leave it as this. Okay. So from the format I gave to you, the first item is sales. I will only write down sales if in the question I have selling price. Of course, examiner has given us selling price. Therefore, I'm going to calculate sales. So let's go and do our working. This page will be sufficient for that. The next one will be our working. So we stop at working number 1 for market value. Okay. Let's continue our working from here. Working number 2 now, which is for, I want to calculate. First thing first, I need number of years. So I have year 1, year 2, 3, 4, and 5. Units. What are the units given to us in the question? Give it to me, please. The first year unit produced and sold is 15,000. 15,000. What's the second year number of units?
40,000.
40,000. Next one.
100,000.
Year 4.
120.
120,000.
120,000. And then year 5.
190,000.
190,000. So let's say this is A. Then number 3, I want to calculate sales. Let me rewrite that to make it clearer. Okay, I want to calculate sales. When you want to calculate sales, you need to first of all determine selling price. You go to the question and pick your selling price. You also check from the question if you are given inflation rates. If inflation rate is given, you need to inflate the selling price. Once you inflate the selling price, you now multiply with number of units sold to get your total sales. Therefore, I will then say selling price. Now, I will teach you the method you are going to use on the day of your exam. Instead of using primary school method, I will teach you what you're supposed to do. Follow me. I will then say, I will go back to the question. What's the inflation rate? What's the selling price? Let's go and identify selling price in the question. In the second paragraph, examiner has told you that it is estimated that in the first year, selling price will be 2,000 naira per component. Remember, the last information I mentioned to you when we had inflation in capital budgeting, and I told you specifically that you should note the following. Number A, if cash flows are stated in first year prices or year 1 prices, inflation should start from year 1, because that first year price or year 1 price is the base year price. So you don't inflate the base year price. Rather, you need to start inflating from the following year. Then number B, I mentioned to you that when cash flow is stated, when cash flows are stated in today's prices, year 0 prices, or for our current value terms, inflation should start from year 1. So those information is vital, because when you want to inflate the cash flows, you must know when to inflate. You don't inflate anyhow. So since we are given first year price, examiner has told us that in the first year, selling price will be 2,000 naira. That's first year price. It means that the 2,000 naira is a real cash flow. So let's go and inflate it. Before that, what's the inflation rate on selling price? You are told that why the selling price is expected to increase by 8% per year. No, what's that? Hold on. Selling price. Okay, let me read it clearly. The variable cost will be 800 per company and total thereafter. Why the selling price is expected to increase by 8% per year. So inflation rate on selling price is 8%. So that's 8%. So I will then come here. Selling price is 2,000 naira for first year. This is at 8% inflation rates. I will show you the primary school method and you decide which one that is more suitable for you. But on the day of your exam, this is the method I want you to apply. Therefore, I want you to, let's inflate this together. So you bring out your calculator. Remember, when I was explaining inflation, how to convert money cash flow to real cash flow or real cash flow to money cash flow, I gave you a formula. I said money cash flow equal to real cash flow multiplied by 1 plus general inflation raised to power n, because you want to increase it. So this is the same formula. But again, I mentioned to you that this formula is useless because I don't need it on the day of exam when I'm calculating. I just ignore it because it is implied in the question. So if I want to do this on the basis of my selling price, so the real cash flow is 2,000. I can just say 2,000 multiplied by inflation rate is 8%. So 1.08, then raised to power 1. So I will get my answer, but I don't need this in anything for anything. Just ignore it. Okay, ignore that. So what am I supposed to do now? If you say I should ignore, so what am I supposed to do? Simple. So you just come here, bring out your calculator. 8% is the inflation rate. Therefore, 1.08 multiplied by 2,000. What do you get? What do you get? 1.08 multiplied by 2,000.
2160.
2160.
Okay, 2160.
2,160.
So 2160. 2160 multiplied by 1.08. Keep moving, keep moving.
2333.
2333. What you have in your calculator multiplied by 1.08.
2519.
2519 multiplied by 1.08.
2721.
2721. So we have inflated the selling price. If I don't want to follow this route, if I want to do primary school method, what I will just do is to say 2,000. This is a waste of time. I will just do 2,000 for all of them for the next 5 years. 2,000. That's my selling price. I will then say inflation at 8%. What's wrong with you? At 8%, which is 1.08 raised to power 0, 1.08 raised to power 1, 1.08 raised to power 2, 1.08 raised to power 3, 1.08 raised to power 4. This is a waste of time now. How can I be doing this on the day of exam when I have a shorter method of doing it? So anything raised to power 0 is equal to 1. 1 multiplied by 2,000 will give me 2,000. So this one also should give me 2160. This should give me 233. This should give me 2519. And then 2721. So this is the inflated selling price. So I don't need to be doing this. It's a waste of time. I would have moved to the next one. We are still doing this one. All right. So if you think this is a cheaper method of doing it, so be it. But don't go and be doing this on the day of the exam. It's a waste of time. Again, if this one is more convenient for you, there's nothing stopping you from doing it. Okay, then. So total sales now. So let's say this is B. Therefore, sales will then be A times B. So let's multiply. Don't forget our figures are in thousands. Figures are in thousands. So A times B. So what do you have there? A times B. Yes.
30,000. The first one.
First one is 30,000. Next. You guys should be fast. You should be giving, you should be up and
Next one
coming.
is 86,400.
86,400. I will start calling names. Now it's like some of you are not there online. I can't sleep here. This one will be 2, 3, 3, 3, 3, 3. I think whatever it is.
233
300. Thank you.
Yes, sir.
Three zero two 280.
302 280.
516,990.
516,990. Thank you. So now that we have value for our sales, then let's go on the post it. You don't wait until you finish all your workings before you post. As you finish one, go and post, because time may not permit you to be doing all of that, especially if it's a compulsory question. So as you are done with one working, immediately go and post. So let's go and post that. 30,000. Year one is 30,000. Okay. Year two, 86, 400, 233, 300, 302, 280, then 519 watts. 516,990. 990. Working number 3. So move to the next one. We also have variable costs. So let's go and do workings for variable costs. Working number 4. Variable costs. Variable costs per unit is 800 naira in the first year. And then inflation rate for variable costs, we are told that variable costs and fixed costs are expected to increase by 5%. So inflation rate is 5%. Therefore, following the example of selling price, 1.05 multiplied by 800. This 840. 840 multiplied by 1.05. 840 multiplied by 1.05 equal 882 multiplied by 1.05 equal 926
926.
multiplied by 1.05
972.
972. Thank you. Then total variable cost in thousands. This, let's say this is C, therefore A times C. The unit produced is 15,000. So 15,000 multiplied by 800.
12,000. Like 12 million.
That's 12,000. So next one is 40,000 multiplied by 840.
33,600.
33,600. 88,200. Then 926 multiplied by 120,000.
111, 120.
111, 120. 972 multiplied by 190.
184, 680.
184, 280.
680.
680. So let's go and post. $12,000. It's a cash outflow. The next one is it 30,000 or what? 33,600. 33,600. Here is 86, 88, 200.
200.
Then year
111,
4,
120.
111, 120. Then year 5,
184, 680.
184, 680. This is working number 4. Then we go back to the question. Let's go and identify other relevant cash flows. You are also told for that there's a direct fixed cost. Where is that information? Yes, total direct fixed cost will be 6 million naira. So we are given direct fixed cost. Direct fixed cost is a relevant cost. So I will say direct fixed cost. There is no need to do working for this because it's not relating to any number of units. So all I just do, the first year price is 6 million. So I'll come in and put 6,000. Let me rewrite this because of space. Direct fixed cost, inflation rate is 5%. Let me draw a line. So after this, let me just draw a line. So you have to manage my straight line now. Okay. You manage it. After I'm not using ruler. So you manage it as you are. Okay then. So because the fixed cost does not relate to number of units, therefore I will just say 1.05 multiplied by 6,000. What do you get?
6,300.
6,300 multiplied by 6,600 multiplied by 1.05.
6,900.
6,900, and the last one
7,300.
73. That's this. I'm done with that. I will go back to the question, what are the other relevant cash flows? You also told that training and development costs are expected to be 120% of variable costs in the first year, 40% in the second year, and 10% in each of the following 3 years. So let's go and do working for training and development costs. Working number 5. Training and development. Okay. So we are told that training and development is a percentage on variable cost. Okay, percentage on variable cost. So T and D on variable cost. Let me just say total variable cost, total variable cost. So the first year we are told that C and D will be 120%, spread to be 120% of variable cost in the first year.
Sir, please, sorry to interrupt. The fees cost is wrong for the third year. It's 6615 and so
Six,
on.
okay, 6615
Yes, not
for the,
66. Not
oh, okay,
third
not
year.
600.
Yes.
Even the 4th year.
Even the like continuously are wrong.
Oh yeah, do it again.
6946 for the fourth
Six,
one.
six. The fourth year, encore.
6946.
Okay.
The 5th one is 7293.
7293. All right, then.
Yes.
Thank you for the observation. So let's move on. Let me write this so that when you are 46. Okay, then. So we are told that training and development on total variable cost for the first year is 120%, followed by 40%. Then it will be, I think, 10% subsequently. Okay, 10%. Please, on the day of your exam, don't go and be doing this. This is a waste of time because you can see the variable cost in step 4. Just multiply the percentage on the variable cost, you move on. In fact, you don't even need to do working for this one. But in order to avoid mistake, that's why you have to write it out. If not, just multiply with the variable cost, you already have it in the table. Therefore, I would then say T and D. So what's 120 of 12,000? 1.2 multiplied by 12,000. What do you get? Yes?
14400.
14,400. 40% of 33,600.
13440.
13,440. 10% of that will give me 8,820. 11,112. Then 18,468. So let's go and post. Training and development. 14,440 for the first year. So training and development dash 14,400. The second year is
13440.
13,440. 13,440. 8,820.
8820.
820.
Okay.
11,112.
112. And then the final year
18,468.
18,468 what?
8.
Okay. So that's that. So let's go back to the question if there are other relevant cash flows. When you look at the first paragraph of the question, examiner told us that for this purpose, the company has recently purchased a patent right for 15 million naira to produce the component. Patent right of 15 million naira, is it relevant or irrelevant? I'm asking, patent right of 15 million naira, relevant or irrelevant?
Is relevant.
Why is it relevant?
Because it was bought because of the project, the components.
Okay, because it was purchased because of the component, because of this project. Okay, any other arguments in favor or against? Patent right of 15 million, relevant or irrelevant? Yes? Talk to me. I'm asking questions.
It's irrelevant.
Mr. Robert, relevant or irrelevant?
Irrelevant.
Why is it not relevant? Why is it not relevant? Yes? Are you still there? Anyway,
No, I'm here. I believe it's irrelevant. I'm just trying to articulate the justification, but I believe strongly that it's irrelevant.
you must be able to provide justification. In any case, because of time, you are told that the company has recently purchased the patent rights for 15 million to produce the components. That patent rights of 15 million is a sunk cost, it's a past cost. Has recently purchased, the word purchased is a past tense, so it's a sunk cost. Therefore, the 15 million naira is irrelevant. Next item, Ferrari PLC has spent 20 million naira developing prototypes of the components and undertaking market studies. So again, 20 million naira for development costs, relevant or irrelevant?
Irrelevant.
Irrelevant, why?
Development costs. Undertaking market studies.
Yes, why is it not relevant? Okay.
Has spent. They've spent is sunk also.
It's a
It's
sunk
something they've
cost.
already spent, yes.
Yeah, it's a sunk cost. It's also irrelevant. So when you are stating your assumptions, these are the things that you are going to be commenting on. So the 20 million naira and also 15 million naira are irrelevant and therefore should be ignored. So that's that. So those are the cash flows we have in the question that are not relevant. Every other ones we have considered them. So in that case, let's move on. So at this stage, we need to determine the profits. Yeah, pick it one by one. Give me the profits. Okay. Give me the profits. Let me pick one. So you two, so let's pick it one by one. Year 1, year 2, up to year 5. Let me do year 4. 302, 280 minus 111, 120 minus 6946 minus 11112 equal.
Year 5.
Okay. I think this one is 173. This is 173. I'm coming. 173. What do you have there? 102. You say year 5. Give it to me.
306,549.
306,519.
449.
Okay, 549. Yes. Year 1 to 3.
Year 1.
Year 3.
Year 1 is loss of 2,400.
2,400 negative. Year 3.
Year 3. 129665.
129665. Year 2. 86,400.
Year 2 is 33,060.
Okay, then. Thank you. So that represents profit or loss. In any year a company make loss, you don't pay tax. Okay, whenever a company make loss, you don't pay tax on loss. That would be double jeopardy. So you are expected to carry your loss forward to the period, to the future, when you'll be able to make profit and first of all recover your loss before you pay tax. When you look at the question, examiner has told you that there's a particular comment in the question. Yes, in the paragraph after the first table, where you have number of units, the last sentence there, you are told that the company makes sufficient profits from its other activities to take advantage of any tax loss relief available from this project, meaning that you are supposed to relieve the loss in the first year, the loss of 2,400, you are expected to relieve that loss because you are told that the company makes sufficient profit. In that year one, the company made profits from other business activity from which you are supposed to relieve the loss. Therefore, first thing first, I would then say tax. The company tax rate is 20%. Therefore, what's 20% of 2,400? That should be 480. This 480 is a relief. You are claiming it's a kind of claim. You are relieving it, okay? Because you have to relieve your loss before you pay any tax in any year. So you are relieving it. But in year two, you are paying tax. There's a profit in year two. 33. So what's 20% of 33,060? Give it to me. Yes? I can't see your voice.
6,612.
6,612. Okay. In year three, 20% of 129,665.
125,933.
125. No. 20% of 129,665.
9,000.
25,933. 25,933.
25,933. Okay. Year four, 20% of 173,102.
That's 34,620.
34,620. Year five, 20% of 306,549.
61,310.
61,310. That's that. So with this, the next item will be for me to calculate tax saved on capital allowance. Remember, we are following a format. So let's go and calculate tax saved on capital allowance. So that will be my working number 6. Let's go and work it out first. And this table accommodates 5 years. No, let me come here. Number 6, tax saved on capital allowance. Okay. So you create a column for year, narration, the cost of the projects, of the assets, the entire saved on capital allowance at the company tax rates of 20%. Of course, our figures are in thousands. So year 0, the cost of the project, the cost of the assets is 480 million. So year 1, you are going to claim capital allowance. I will then go to the question, how am I going to claim my capital allowance? We are told that capital allowance is on a straight line basis. Okay? Tax allowable depreciation is available on the machinery at 10% on a straight line basis. So I don't need to stress myself. So I'm not given initial allowance, I'm only given annual allowance. And we are told that annual allowance is at 10% on a straight line basis. 10% of 480 will give me 48,000. So what's the difference? What's the hiatus between 480,000 and 48,000? That's
432,000. That is the tax written down value.
432,000. So here is tax written down value at the end of year 1. I will then go to year 2. Annual allowance, it's a straight line basis, 48,000, the same amount. So what's the difference? That will be 3 what?
384,000.
384,000. Tax written down value at the end of year 2. Then annual allowance In year 3, 48,000 minus 384. What do you get?
336.
336,000. Tax written down value at the end of year 3. We are going to year 5 because the useful life of this asset is 5 years. So year 4, annual allowance, 48,000 minus 336.
288.
286.
288.
288,000. So this is tax written down value at the end of year 4. The final year is year 5 when you are going to dispose of the assets. Therefore, at the final year, you need to compare the tax written down value from the preceding year with the sales proceed. So the sales proceed, we are told that the machinery will be disposed of at 160,000 naira. So the difference of 128,000 would then be balancing allowance. So this is balancing allowance in year 5 when disposal value is less than the tax written down value, or when tax written down value from the preceding year is greater than the sales proceed. The difference is called balancing allowance. If otherwise, it will be called balancing charge. Somebody, Mike is making noise. Please, Jide, mute yourself. Jide, mute. Okay, thank you. So let's calculate tax saved on capital allowance. What's 20% of 48,000? That would be 9,600. 9,600. 9,600. Same amount. Then what's 20% of 128,000? That should be 25.
25,600.
600. Thank you. So when you add up everything, what do you get? This represents the total tax saved. TTS. What's the total tax saved? Because you cannot claim more than the capital allowance you are supposed to allowed. So to confirm your total tax saved, total capital allowance claimable, so it will be cost minus scrap value multiplied by the company tax rates. So in this case, it will then be 480,000 minus scrap value of 160,000 multiplied by 20%. So what do you have there? What's the total tax saved?
64,000.
64,000. So you can't claim. So for you to know, when you do 480 minus 160 multiplied by 20%, it should give you the same thing as 64,000. So you can't claim more than what you are supposed to claim. So that's that. So let's go and post. Tax saved on capital allowance. So again, like I mentioned, when I was explaining the concepts, your tax saved on capital allowance will follow the patterns of your tax liability. If your tax liability is in the current year, your tax saved on the capital allowance must also be in the current year. If your tax liability is in arrears, your tax saved on capital allowance must also be in arrears. So here is 9,600. Is it 96 or 98? I think it's 96. 96 is a claim. So 96, then 25,600. All right. Let me confirm whether it's 96 or 98. Yes, 96. Okay, then. So what's the next item? Immediately after the tax save, you need to consider scrap value. So we are told that the salvage value from the project is 160 million. I want to know, is this salvage value? Yes, the machinery is expected to be sold. So that's disposal value. So I can say sales proceed. Sales proceed will occur in the final year of the assets. which is 160,000. Then after this, I will have the initial outlay. The initial outlay of the machine is 480,000. It's a cash outflow. Okay. After this, you consider working capital if given. If given, working capital is given in the question. So let's go and do working for our working capital. Let me just use this place. Working capital, note 7. So let's go back to the question. How are we going to treat the working capital? We are told in the question that initially, Ferrari PLC will require additional working capital for the project of 20% of the first year sales revenue. Thereafter, every ₦1 increase in sales revenue will require a 10% increase in working capital. So working capital is on the basis of sales revenue. So here I have year 1, year 2, year 3, year 4, year 5. Then I can have a column for total. Okay. Now, my working capital, we are told that is on the basis of sales revenue. First thing first, you need to determine you are told that the working capital is 20% on sales revenue in the first year. Thereafter, any ₦1 increase in sales revenue, you should charge 10%. But first thing first, we need to determine incremental sales. Okay. Increase in sales. Increase in sales. The first year sales based on our working is 30,000 naira. The first year sales is 30,000 naira. So I will say 30,000. So from that 30,000, it increased to 86,400. So 86,400 minus 30,000. So it has increased by 56,400. So 86,400 has also increased to 233,300. So what do you have? What's the difference? 233,300 minus 86,400. Yes.
146,900.
146,900. 146,900. The next one, between 233,300 and year 4 sales value, which is 302,280 minus 233,300. What do you get?
68,980. 68,980.
68.
Yes, 980.
980. 68,980. The last one, which is 516,990 minus 302,280.
214,710.
214,710. Okay, so these are the increments, these are the incremental sales. It's not what we are looking for, but examiner has told us that the cash flow, working capital is, I would say working capital on sales. We are told that for the first year is 20%. Every ₦1 increase in sales, you are supposed to charge 10%. Again, there is no need for you to come and be writing the percentage on the day of your exam because you can see it. Just determine the value and move on. You have to save time. Therefore, the working capital would then be 20% of 30,000 will give me 60. Will give me 6,000. 10% of that will give me 5,640. 14,690. 6,898. Then 21,471. So these are the working capital, which is the same thing as incremental working capital, because I will say incremental working capital because our sales has increased by 30,000 from 30,000 to increase by 56,400. It also increased by 146,900 and all of that. So that's incremental. What we have just determined is the incremental working capital. When you add up everything, what do you get? Add up everything. 6,000, 5,640, 14,690, 6898, 21,471. What's the total? Yes.
54,699.
54,699. Okay. Let me write that. 699. Remember, when I was explaining working capital, I said for incremental working capital, it should be treated as cash outflow. In the year, only the increment should be considered. However, it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. The working capital that occurred in year 1 of 6,000 should be treated as cash outflow in year 0. The one of year 2, cash outflow in year 1. The one of year 3, cash outflow in year 2. The one of year 4, cash outflow in year 3. The one of year 5, cash outflow in year 4. Then at the end of the useful life, which is year 5, you recover the entire working capital. So the total working capital is 54,699. So that's what we are going to recover. Okay then, so let's go and post 6,540. So this one is 6,000 in year 0. 5,640. What's the next one?
$14,690.
14,690.
And 6,898.
14,690. Then 6,898.
Then 21,471.
471. Let me write that to make it clearer. Then 54.
699.
699 is what we are going to recover, working over 7. Okay then. So that's that. At this point, we need to determine the net cash flow. Here is the net cash flow. So let's find the net cash flow. I know this one to be 486,000. Net cash flow, discount factor, then present value, then net present value, NPV. That's it. What's the net cash flow?
2,014 naira. 2040.
2040.
21,358.
What year? 21,348.
Yes.
358.
58.
358. Okay. That's not. Okay, next one.
One oh 106,434.
106,434.
126,611.
126,611. Yes.
Four 485,539.
485,539. Okay. Are you sure? Let's
485,538.
485,538. Okay, 538, 539, 538. Okay. Nine. Okay, that's 8. So discount factor. What's the cost of capital given in the question? 20%. No, cost of capital is
No, we calculated it at 12%.
yes, we have to use 12%. Examiner wants us to use 12% cost of capital. So since we are not told whether it is money cost of capital or real cost of capital, so it is assumed to be money cost of capital. So for year 1 is 1. So at 12% for year 1, what do you have? Year 0 is 1. Discount factor at 12% year 1.
0.893.
0.893.
893. Year 2.
0.797.
Year 3.
0.712.
Year 4.
0.636.
And then year 5.
0.567.
Thank you. So let's get the present value.
$214.
214. What did you say? Which one is 214?
Year 1, 1,822.
2.
1820.
No, 2.
22.
822.
Yes.
Okay. 21,358 multiplied by 0.797.
That's 17,022.
022. Year 3. 106,434 multiplied by 0.712.
75,781.
781. Okay. Then 126,611 multiplied by 0.636.
That's 80,525.
525. Then lastly, 485,538 multiplied by 0.567.
275,300.
275,300. So you add up the positive present value. You net of 486. Final answer. What do you get?
Negative 35,550.
Thank you. 35550 negative. So examiner is now asking you to assess whether Ferrari PLC should undertake the project of developing and commercializing the major components of outboard engine. So you have to advise. So what am I supposed to do? I would then say the projects to commercialize, the project to develop and commercialize, projects to developing and commercializing. Let me write it so that you don't think that's the appropriate thing to do. And commercializing the major components of outboard engine is not financially viable, considering the negative net present value. What's your problem? Net present value let me write this, of 35,550,000 naira. Therefore, the company should not undertake the projects. Therefore, Ferrari PLC should not undertake the projects. That's that. Number C, you have to state any three relevant assumptions made for your calculation in A and B above. Again, 3 marks. This is another bonus 3 marks. Okay, let me come here. So, number C, assumption. You can see it's a big question. That's why we're saying over almost 2 hours now we have been on this question. But if you are the only one solving it, you can't spend 2 hours on a compulsory question. So that's a recipe for failure. So you can't spend 2 hours on a question, no matter what. Worst case, between 45 minutes and 1 hour, that's okay. The remaining 2 hours, you spread it across the remaining 4 questions. But you have to start small. You make this compulsory question the last one, last attempt. So the assumption, I would then say the calculation above is based on the following assumptions. So what are the assumptions that we have made so far? Examiner is asking you from A and B above. So what are the assumptions we have made in A and B? Number one assumption, when we calculated the cost of capital, what assumption did we make on the cost of capital? So you are going to talk, yes, we talk about debt beta.
Yeah.
We can talk about debt beta. Because since debt beta is not given, it is assumed that debt beta is risk-free. That's your assumption on that. So I don't need to be writing all of that so you can hear my voice. So you can't just write debt beta. You have to continue it. Let me just give you an example. I'm just watching the time. Okay, since debt beta is not given, it is assumed to be risk-free. It is assumed to be risk-free. Number two, another assumption we made under cost of capital is business risk. Business risk. What do you mean by business risk? Okay, it is assumed that both Ferrari PLC and Costaris PLC have similar business risk. Okay, so we're assuming that the two of them have similar business risk. That's why you are borrowing the beta of Costaris to calculate cost of capital for Ferrari. So that should be okay under cost of capital. Then number three, we also have sunk cost. Sunk cost. What's our assumption? I would then say the patent rights of 15 million naira and development costs of, how much is that? Is it 20 million? The development cost is, yes, 20 million naira, cost of developing prototype of 20 million naira as sunk costs. It's better to use the terminology sunk cost instead of past cost as sunk costs, and therefore irrelevant to the calculation. That's our assumption. Number four, we can talk about cash flow. At all time, whenever you are doing cost of, whenever you are calculating NPV and you are asked to state your assumption, you have to talk about cash flow. So it is assumed,
reliable.
it is assumed that the cash flow estimates are realistic. All those 2,000 naira for selling price, 800 naira for variable costs, we are assuming that they are realistic. And will occur at the end of each year. It's after 12 months. The cash flow of year one will be at the end of year one. You have to count 12 months. So at the end of each year, if you want to go further, you can say that all cash flow All relevant cash flows have been inflated at the appropriate inflation rates. So that's that. Then number 5, if you like, you can talk about inflation. You can talk about inflation. So what's your assumption under inflation? It is assumed that the inflation rates will remain constant within the relevant range. Within the relevant range or period under consideration. It will not change. Again, if you like, you can comment on the cost of capital. What's the assumption under cost of capital? It is assumed that the cost of capital, it is assumed that the cost of capital of 12% is appropriate and consistent with the business and financial risk. With the business, omitted the. With the business and financial risk associated with the projects. So any other assumption you think appropriate. If you mention 5, you are good. It's just 3 marks. If you mention even 3, you are good to go. Again, if you do more than that, there's no harm in doing that. So this is where we are going to stop. So let me know what else. I think that's end of the question. That's it. When you do this, the way we have done it, you see that if examiner like you, the way you have done your analysis, just the way we have done it, you can earn the entire 30 marks. If examiner has 1 or 2 areas of concern, you may be given between 25 and 28. It's still something. Go and look for 22 or 25 elsewhere. All right? So that's it. So let me hear from you if you have any question for me. Any question so that we can close the class?